Nicola will pick it up. Sounds good? Look at me, Nicola.
Yeah, I will. Just, let me get a microphone. Sure. I'll try. I'll time myself. 8 minutes sharp.
Sorry, you lost 30
Everyone counts.
Give me a start. I'll go.
Start.
She's about to do it.
Just talk about
Thank you. Great job, Emily, Emanuele, Chris. Thank you. It's fantastic to be here. Great conversation yesterday, and great to see this field developing. This is joint work with Nissan Rats in Washington St. Louis and Punag Ghosh at IIMB Bangalore on household portfolio and deposit insurance. Let me give you what we are trying to do. We know that firms face financial constraints. Long discussion on that. We know that financial institutions have financial constraints. So the idea of this piece of research is to study how we use the financial constraints of financial institutions in a way that will spill over firms. So basically, today we'll focus on this first part. And so this paper is about deposit insurance, a piece of financial regulation, very popular, probably the most important one. And now that affects household portfolios, figuring out the choice between deposit and fiat. And what are the welfare effects of that? I probably don't have time to talk about it, but just give it a sense. Basically, the deposit insurance as the for households. And there is going to be some fantastic data from a large private sector bank in India, 300,000 individuals. We can see all their deposits, all their stock holdings, the type of security per month over time. We do 7 million observations. And there is a big change in insurance in India, which began both from around $1,000 to $8,000 in 2020. Bunch of methods. I'll show you some of the things, the usual things that you can imagine. And let me give you one theoretical intuition, which I think delivers the paper. So if you think of a two-period model of endowment allocation where you consume today or you save, what we're used to see. So on the x-axis is savings, deposits. On the y-axis is future consumption. And this is the remuneration on your savings. Now, if you put a bank, there's going to be some probability of default. Your deposit remuneration is going to be scaled down by the probability that the bank survives. Now, what deposit insurance does is to make this convex. So up until the threshold of deposit insurance, you get your remuneration for deposits. After that, you will price in the likelihood of default. If you put this together with standard models of bunching, a la Clement, Sheffield, and so on, you will get bunching. Individuals will bunch their deposits because they are basically unhappy with this decline in remuneration. So think about some individual with some wealth, he will be so-called insensitive by chance. He will be saving the threshold of deposit insurance. You can think about someone with a higher wealth. He will place more of his wealth into deposits. This is when there is no probability of default and some deposit insurance. When there starts being some probability of default and many banks in many different countries, this individual will decide to keep the threshold. He will bunch because he's worried of the likelihood of default. And so he will put some of his wealth into his asset. So the proposition here is that an increase in deposit insurance will have an effect on marginal bunchers who will reallocate this wealth away from the risky assets towards deposits. And in the mind of, Bajamian, Paravicini, and so on, that's going to push up deposits of the banks and hopefully have an effect on loans and so on and so forth. So that's what we are testing in this project. So an increase in deposit insurance will push deposits up, risky asset holding down, ambiguous effect on welfare, if following from the literature and the work of Manju and many others. Basically, we know that deposit insurance is good for the depositor, but the bank is going to take on more risk because there is monohazard. Depositors don't monitor me, so I can give crappy loans out, which increase the probability of default. So let me try to present multi pictures. This is the average deposit of the bank before and after the increase in insurance. Again, this is only descriptive. Deposits go up. There may be many reasons about it. Take advantage of one cross-sectional prediction of the model. Everybody will be affected by deposit insurance, but bunches are going to be affected more. And so that's going to be our exercise. Time series variation before and after the change in insurance, cross-sectional variation between bunches and non-bunches, and then we exploit that in a more refined way. This is the distribution of deposits around the threshold 12 months before the policy. this is the distribution of deposits after the policy around the threshold. So basically, some people just disappear. They are no longer bunching. They are increasing their deposits by 5%. This is the event study specification. You cannot see it, but it's a standard event study where we have an individual effect, so I can follow it with each person. They can account for a bunch of zip code time, geography time, to take account of other shocks. Now, they increase deposits, but they are cutting what? They're cutting risky stock holding. So we can study the stock holding of individuals with security time fixed effect. So I'm only comparing a buncher to a non-buncher once I factor out all fundamental news. And I can see that there is a sizable decline in stocks once we have an individual fixed effect and a system fixed effect. Now, we are thinking of deposit insurance in introducing a safe asset in the economy for a reason. We look at which stocks are people cutting. And we take advantage of the methods developed by Tarun and his co-authors. We look at portfolio tilt. So for each individual, we see a bunch of characteristics and we see how are the portfolios being reallocated. There is only one characteristic that predicts the decline in stock holdings, and it's state-owned enterprises. So bunches were loaded on state-owned enterprises, and they cut them in the aftermath of deposit insurance. That makes us think that individuals were looking for quasi-insurance. So they couldn't take safe deposits. They went into the risky asset, but they got the safest type of risky asset, those that have some form of government guarantee. Now, the unloading of big stocks from the market has effects. So here we are comparing, there are temporary asset pricing implications of deposit insurance. We are comparing the cumulative abnormal returns of state-owned, the stocks of state-owned enterprises, those of business groups, the Ambani, the Tatas, and the rest of the Indian stock market. We see that within a month, there is a decline up to 5% in the returns of these stocks. And then this is transient. I mean, in the end, it disappears because probably people take advantage of this temporary drop. The last part is going to be on welfare, and we have two results, and also 1 minute and 20 seconds. So let me tell you the first thing. So we use the model of structural estimation with simulated method of moments. One thing we managed to get is to back out the depositor implied probability of default. Why were depositors bunching? If probability of default is 0, there is no bunching because there is no decline in your deposit remuneration. The second thing that I find more exciting is thinking about whether individuals are better off with this policy. And let me show you what I mean. The model has a natural trade-off we know in finance on deposit insurance. Why? You can pull deposit insurance up, you can increase insurance. Basically it means moving its convex in here. But this lowers, basically, if there is a return on more hazard, this makes this part of the curve flatter. So you can see there can be redistributive effects of deposit insurance. You are quote unquote taxing wealthier depositors and redistributing away to individuals who were in the middle. And so long story short, we see that we can basically account for the fact that deposit insurance delivered welfare effect. And to make this effect 0, you need to make crazy assumptions about moral hazard that banks basically increase their likelihood of default by around 10 times. So deposit insurance gives an accessible safe asset. There are effects on insured depositors and portfolio. There are positive welfare gains, and this is my literature on my agenda, what I'm working on financial development and regulation. No. Too many slides, too much, but I gave you, I hope, the point. Yes.
So, clarifying, to what extent in India there is stock market participation? Is this an average person doing a lot? Like, what is this average buncher?
So, in our bank, over the 300,000 people, we see around 40% of people that have an account. But here, you don't need to think that people that have a bank account in this setting are representative of the population of India. I think we are basically selecting on individuals with high income and relatively high wealth. So I agree, this is not about the middle of the income distribution, but I think this is about the average people among those that have a bank account and are relatively wealthy.
Like more than 100 million people in India with a registered stock trading accounts.
No, but I mean, I can have E-Trade account, but do I use it?
Oh, they use it. I mean, these people use it and they reallocate, right? I mean, this is, not only whether they have a stock or not, we can see all their holdings over time. And that's how we build portfolios. As a rules, a lot of people are trading options. So there is some degree of sophistication. And one thing, I'm not saying that everybody is the only way to hedge. You may buy gold, you may have other exposures, but we see this very strong reallocation. Tommaso.
So the rationale, if I understand correctly, of this, it is essentially to have banks access to more deposit and then to pass through the additional liquidity into more loans. Is that true?
That would be kind of, yeah.
And if so, did you see that happening in the data?
We are not starting yet the part on lending. That's kind of the next part of the paper. Ideally, what I would want is for all banks in India, know what was the fraction of bankers over their total deposit, so that I can use that as an exposure to study the increasing lending and eventually structural transformation. I don't know whether we get that. Kulak, is the data genius of India, so we hope he will be able to retrieve some of that. Because
I guess what I'm trying to understand is from a real effect in terms of actually having capital financing, successful project. Is this good or bad?
If you want to study,
because you have a welfare, is a partial welfare characterization, I guess this one doesn't take into account the productivity effect of this policy, right?
Correct. And we need more data in a sense to do that. That's where we are going. Hoping that we can get more data. Yes. And then
what about assets like gold or something like that? Would that not be a more safe?
Gold is super important in India. As Tarun pointed out yesterday, people hold it as an hedge. It's a reasonable hedge. Unfortunately, we don't have individual data on gold holdings because most people will keep gold outside of the bank. If they had a future or something on gold, I would be able to study it. Unfortunately, it's not there. So we're not saying that gold is not a good hedge. We're just saying that at the margin, individuals that chose banks, they work on this reallocation. Emily.
I just wanted to second Tommaso's interest in the asset side of the bank's balance sheets, because it seems like it's especially sticky deposits, right? If they're bunching, then I would imagine they're parking their money there and they're not doing much. Sticky deposits are good for.
Of course, they are good for low volatility, so that will be easier for banks to be transformed in long-term loans. So that would be, once we get there, there is a level effect, more deposits in, and the fact that depositors are reacting less to bad news, which would make deposits less volatile, and so would simplify the maturity transformation and increase the supply of long-term finance. You're right. Once we have the data, hopefully we can be able to tell these stories apart. And yesterday there was a lot of, also after your presentation about thinking of levels and volatility and how that affect the supply of credit and potentially long-term finance.
Oh.
Yes,
I missed it, but is this crowding in more safe? Yeah, overall. So is this just a reallocation from the risky asset to the safe asset, or is it an overall increase in participation, in money that it goes into the bank, basically?
So, just to be careful, our sample is kind of selected because we follow everybody that had been having an account 12 months prior and that continues to have. You have a point. Deposits go up at the bank level. That's one of the pictures I showed you. Now, is that 100% caused by the policy? We don't know. We can make some informed guess around. We can make some informed guess about how much of that is due to the policy using maybe the structural model. We are not studying crowding in. Do people open an account because they feel the bank is safer? Honestly, I don't think that's going to be the case. I don't think that individuals that are these are sophisticated people, right? They were, not only they do this reallocation, but ahead of time, they were allocated, they were worried about risk. So if we want to, the trade-off is between external validity and internal validity. We think the study is internally valid. Do I think that all banks in low and middle income countries work with this? No, but people are worried about the solvency of their banks. And so that's why they may not participate. So in a sense, deposit insurance and other policies, by making banks safer, can push people to participate in the financial system as a choice. Thank you.
Next presenter is Francis Annan.
Yeah.
By the way, a reminder to shout for all of us asking questions, including you, Emily.
Thanks a lot, everybody. And sorry, Emily and in my home institution, there's something called Berkeley time. It's fine to be. It's fine to be 10 minutes late on everything. I think it's fine. So playing. But I thought I would just spend my time talking a little bit about this extremely brand new project, unlike Nicola, who has fully fledged results. And I'm going to spend my time hopefully piggybacking on some comments you have on this. It's extremely brand new. Okay? And it's going to be about what I call beliefs over contract. And the basic premise for this project is based on the recollection that there's a lot of work in economics thinking more broadly about really the impact of different contracts, in this case, bonus structures and all that how to do. I think what we don't know a lot about, more fundamental and perhaps more important, is the fact that we don't understand much about why firms, okay, would choose different contracts, okay, over the other. And more profoundly, really, whether really firms even understand the implications of choosing one contract. Okay, so that's where we are going. What we're going to try to do is to implement what I call almost a nationwide randomized experiment. Okay, so it's going to be in partnership with, one of my long-standing partners, MTA. And I'm going to list as many questions that I can, because we hope this can, we'll uncover a lot. But I'm going to list more than I'll present today. Okay, so the first question is going to be really, what incentive contracts really in this case is going to be bonus contracts? Do firms or managers believe to be best? Okay, or when offered and why? Okay, that's going to be the first. Let's do more descriptive. The second part is going to be, then we're going to turn to the field. Okay, then we're going to ask what in contract in practice actually are optimal. Okay, or work best. Context. Then we're going to bring the two pieces together and ask really how well do managers' predictions actually align with actually what is actual. Okay. And then hopefully, I don't think I'm going to show you more results on that, but I guess, we're also trying to understand what leads some managers to be more predictive than other managers. Okay, more general. So that's where we are headed. Okay. As I mentioned, it's going to be an experiment, and this is going to be, in this, gigantic, very deep partnership with MTN. It's going to be a two-part exercise. The first part is let's call it, kind of eliciting beliefs, right, from managers. This is going to be close to about 500 managers that work nationwide for MTN, okay, across the country. So first, we're going to gather these beliefs or predictions over 5 different contracts. And essentially what we're going to do is we're going to present managers with these alternative contracts, and we ask them to rank them on the basis of the one they think would actually maximize revenue for the firm. Okay, that's going to be the goal. And we're going to start with what I call basically the standard linear contract, which is basically the status quo. Very popular, very common in digital financial markets in terms of how agents in these markets are rewarded. And the basic way, the way the status quo works is that agents, I'm going to describe who an agent is in a minute, actually are going to receive, commissions or bonuses for every output, okay, that they generate, which is very classic, very standard. Okay? The reason I'm going to propose this for other ones, what I call a flat bonus, okay? The flat bonus essentially is thinking of, full integration of MTN with agents, which is a version of imagine that, the upstream player was to integrate fully with agents and think of these agents as what workers, okay? Or that imply, essentially, you're going to be receiving this non-performance base, okay? Which is essentially what I call flat bonus. So regardless of your performance, you're going to receive some predetermined. Of course, the second kind of alternative we have is what we call the threshold contract. The way threshold works is pretty simple. I think it's used a lot in some other industries. There's this predetermined sales, or you have to accomplish, and then once you hit that threshold, you get a fixed or flat wage. Okay, and that's the second. The third one we're gonna propose and call it pseudo or pure franchising, because the implementation is a little bit different, depends on how you think about it. So the franchising is very simple. Kind of, you can imagine the way Amazon works, right? If you want to list your product on Amazon, you pay a platform fee, right, and then you begin to keep all whatever bonuses or surplus you generate on the platform. So this is a version of the agent paying really a flat fee, okay, to MTN to use the platform, because in this case, the upstream player is going to own the platform, and then they get to keep all commissions that are generated. The last one is the payment, as the name sounds, is more competitive. All agents, in this case, retail agents within a given market, and the market for us is going to be some geographically well-defined communities, okay, about this. We're going to put them in tournaments, and the agent with the highest performance actually in a particular week receives, an additional bonus, at the expense of the others that did not pay. That's how this is going to be. Okay? So these are the 5 space of contracts we're going to tell ourselves. So we're going to propose this 4, and then, the first one being what the industry standard is. Okay? And by the way, I'll tell you more about the basis for this project, maybe later in the Q&A. So the second step, now having elicited, okay, these preferences from managers, we're going to then randomize, return to the field. Okay? We're going to randomize this contract across, all these markets in the country, okay? And then, later we're going to bring them together at the results section. Throughout, I want to emphasize one key thing that we do, I think, innovatively here, is that we're going to design and implement the contract to be expenditure equivalent, okay? So ex ante, we have this expenditure equivalence result that actually shows that on average, the expenditure from the firm to agents are going to be identical, okay, across all the different contracts on average. All right. So let me tell you a bit about MTN, because I'm not sure everyone is familiar with maybe mobile money and MTN more profoundly. So it's Ghana's largest mobile money service provider. Okay, I mean, if you have to put some numbers together, this is roughly more than 90% share of the market. Okay. You know, it's been a very wonderful partner of mine on several other projects. You know, some early work that I did about, you know, studying conduct in markets with agents, all the way down to some new recent work on entry, you know, in today's market, along with some interventions that are ongoing, along with Apoorv on transparency within the marketplace, then now on incentive contracts. So the list keeps going on and on and on. Okay, so very, very nice partner, and been pretty supportive with research. So the way MTN is structured is a multi-layered management, you know, organization. You have the CEO all the way down to the commercial heads, down to what we call, you know, territory sales controllers, which I'm going to think all of these guys are. Okay, and this are going to span the whole country. They use typically incentive contracts to motivate workers. What we call workers here are going to be these retail agents that retail financial services on behalf of MTN, the provider. Okay. And essentially, these agents are going to be interfacing with consumers to deliver these digital financial services to consumers in this very very low income communities. As I mentioned, the status quo contract is a simple linear, and by the way, it's very popular. On the last bullet, you see that. And so basically, MTN unilaterally determines the contract. Okay, then agents are basically going to take this contract as given, and then they're going to exert the optimal effort. Okay, that's how it really works. MTN, you know, is the largest operator in sub-Saharan Africa, and actually it has several footprints across not just in Africa but other parts of the world, including the Middle East. And one really key thing I highlight is basically, as I mentioned, this linear compensation structure turns out to be very, very popular in this industry in terms of how agents are rewarded. Okay? So that's what I have to say about this. So let me spend my last slide because I think I only have 4 slides. Okay, so that's like Nicola. So our first slide is the last slide. So let me tell you what the results are. I'm going to box the results into 2. I'm going to start with the, you know, the descriptive part, which is really about the beliefs over contracts or managers. It turns out, you know, of course, I'm just going to show you the best and the worst that managers rank to be the best and worst. It turns out if we were to actually elicit these incentivized beliefs from managers, actually, you know, the majority of managers think, you know, the threshold contract will be the best in maximizing revenues. Okay. Of course, given that we actually make things expenditure neutral, that means maximizing profit. Okay. And unpredictably also predict the flat will also be the worst contract. I think everyone would agree that. And I think we do that for a lot of reasons. Okay. So now let's turn to the field. You guys have different timing, but it's okay.
I'll start your question.
It's all right. Okay. All right. So in terms of performance, turning to the field, we actually estimate that the tournament generates the highest revenue effect, unlike what managers have predicted. Okay. And then, of course, unsurprisingly or predictably, if you want, we actually estimate that the flat bonus actually generates the worst if you want the least revenue effect. Okay, as one would predict overall. These effects are going to be persistent throughout the time that we estimate. And the stats are just to give you a sense of some numbers. If MTN was to commit to transition, okay, from the status quo contract, which is simple linear, okay, to this newly found, okay, optimal contract, it could increase revenues by more than 20%. More than 20%. So what are we going to do next? We're going to do a lot of stuff to really understand why some contracts work better than others. What leads for managers to be more predictive than others. Then we want to try to estimate maybe, okay, a labor supply model, you know, that we're going to be able to actually even try to think about the optimal contract outside the space of contracts that we consider. I think overall what we do here, and I mean, I'm sure there are several interpretations you could do, you could have them yourself, but I think one of my favorites is really emphasizing really the quality of managerial predictions, right? When it comes to really the sophistication of managers and what actually managers are really predictive of what optimal contract is generally. And I think this is interesting, especially if you think of how we do contract design. Okay, we are done. All right, I think I'll take a question. Questions, please.
I think that you wanted those contracts to be with new equivalent, and I had some question on that, like, did you have to predict the change of effort that the agent would do in each setting to make that equivalent? And is it what we would want? Wouldn't we want to be thinking about, okay, they are like profit equivalent for the firm, and then would the worker want to like choose it? Or it's not obvious to me that in this setting, it's not like a bureaucrat that is thinking about an allocation of bonus. Like,
maybe the way I presented it. So I want to be very clear. This is not ex post equivalent. That's not what I have in mind. I mean, it's ex ante. So before we started implementing the contract, the idea is that we have history of the performance of these agents, and depends on how you design the contract. The way to think about it is, you imagine you have a status quo contract, you solve for that particular contract, identify what the optimal effort, the expenditure, or the bonus structure is, and then you set up all the other 4 contracts precisely the same way and deliver the same expenditure. Ex ante, not exposed. Of course, exposed.
Okay.
Of course, yeah. Over time, that can change. Yeah. I think it's very important. Please, Dean.
Yeah, that was, so it isn't the case that expenditures, so it might be nice to know, was it a price effect or a competition effect?
Yeah.
In terms of the high-low, and then two other very quick questions. One is just, what is the moral hazard? Is it number of, like, what does effort look like here? And then the third is just a longer run, shorter run. Like if you're in a tournament might win, but if I learned that, like, you know, that my peer is a rock star, eventually I give up. So like, I would think that there's some interesting things to look at here on the dynamics, whether the long run might not, a tournament seem like it would have a problem.
Thanks a lot. You know, I didn't have time, of course, with given only 8 minutes, you know, to talk about this, but I think you're really speaking really to the again exactly where we are headed with this project. In fact, I think let me start with the moral hazard part. I think most of the results are going to be driven by labor supply. For the most part, the fact that, you know, some contracts are going to really incentivize against, for example, opening their stores early, closing a bit later, taking a little bit more risk, you know, in that sense. That's going to be the dimension to which the contracts are going to operate. Then on the long run, I wish I had a graph to show you. It's fascinating. Over the 3-month course period, the tournament seems to do, you know, wonderfully better. If anything, it keeps going up over time.
How many periods, like how many times do they hear it back?
Oh, we have we make weekly payments.
It's a weekly thing, or?
Weekly payments for 3 months. And throughout the tournament, that,
well, they hear
the first 2 weeks, nothing was distinguishable, but over time you see the clear distinction between the performance of the different parts. Please. But great, thanks a lot for those comments. So some hand here.
2 questions. One is just to like understand the role of reliefs. It'd be helpful to see if there was heterogeneity in like, were they predictive of heterogeneity? So did the agent, the managers who thought certain contracts would do well, was it those contracts that were their agents did well that sort of insight would be helpful? Yeah. And the second thing is newspaper by Andy Zeitlin looking at performance contracts for teachers in Rwanda shows that the selection margin is quite important. So I think you're working only with the agents that are already selected, right? But it might be interesting to know if they knew ahead of time they were going to be paid based on certain contracts that might also selected different agents. That would be a different experiment. But I think, you know, Andy's work shows there's a lot of room on that margin as well.
Well, totally right. The key distinction between teachers and here is that this is almost like 90% of the market. The market is, if you want, very well developed. So it's not about teachers getting enrolled all the time over time. Okay? That's one. But I think your point on local versus global is quite important, right? That's really a question. Overall, managers may be unpredictable, but locally they may be predictive of the performance of the agent, and that's very important. All right, thanks.
I hope I'm audible. Yes. Okay, thanks to the organizers for inviting me. I'm Nirupama from CAFRAL, which is a research organization set up by India Central Bank, RBI. And this is joint, and the usual disclaimers apply. This is joint work with Meghna at George Washington, Lance at UTSA, and Pulak at IIM Bangalore. And this is early work on interoperable payment infrastructure and retail investment. So the broad motivation for this paper is the rise in retail investors, and this is a phenomena observed globally. And a lot of this has been attributed to the rise in social media and technology. And this rise of newly empowered retail investors has an implication for markets because retail investors might have their own behavioral biases and distinctive motivations. And so the previous work has looked at the role of infrastructure, technology, and product innovation. But one understudied aspect of investment is the role of payment. So think about traditional payment systems where there might be frictions, there might be processing delays, restricted operating hours, fees, and clunky interfaces. So the question is, what if making the ease of making payments easier, could that lower the barrier to investing? And so open real-time payment systems might help increase retail investments, basically by enabling instant zero-cost transactions and seamless integration across platforms. Open payment systems can dramatically increase basically both who participates in the markets and also how quickly investors can respond to new information. And so the broad question in this paper is, does open payment infrastructure affect retail trading activity and market participation, and what are its consequences? So our setting is India. India has the world's fourth largest stock market at $4 trillion with 151 million investors. This is also being accompanied by rapid digitalization. And so much of this growth has been in recent years, as this article on the right shows. So this basically shows that over since fiscal 2018, there's a tenfold increase in new investors. And so we hypothesized that the introduction of the Unified Payment Interface, or UPI, had a role in this ramp up. And so to fix ideas, why would UPI play a role? Think about a digital transaction. So in the traditional process, an investor basically logs into the bank account, adds a brokerage as a beneficiary, initiates an NEFT or RTGS transfer. There's a two-factor authentication. The investor then waits for 2-3 hours, and then the transaction goes through. And there's also associated fees. And so this would be analogous to moving funds in and out of JPM account into a Robinhood, which might be challenging. For UPI, basically the user would select UPI in brokerage, enter amount, enter the UPI ID, open his UPI app, and enter the PIN, and the transaction goes through. So the process is much simpler. Okay, so our main research question is, does UPI lead to an increase in investor participation, and what are the implications for the market? So our main data set is on the universe of all investors from 2004 to 2021, which encompasses about 20 million retail investors and 3 billion observations. We also have access to data on demographics, so age and gender, as well as the specific location of the investor, which is the PIN code, analogous to zip codes in the US. We adopt a multi-pronged identification strategy. So we basically build UPI exposure at the PIN code level. And this relies on 2 key ingredients. First is the UPI user needs a bank account to transact. And second, the bank accounts Second, there's a staggered rollout of how UPI was adopted by the banks. And so we build this geographic exposure to UPI. And basically the idea is that the account hold, so basically the idea is that there are network externalities to bank holding and to UPI transactions, which means that sorry, the time is really
I was thinking.
Okay. So which means that so the network externalities to UPI transactions, which means that areas which had more exposure were on higher growth trajectory compared to areas which were which had lower exposure. So that is our basic identification strategy. We also have a bunch of other specifications. So we have a Bartik specification, which is a shift share specification. We look at within investor analysis. We also look at really narrow windows around market crashes. And we also have a bunch of placebo tests where we look at effects in retail investors, where most of our effects persist compared to our institutional investors. And then we also do a bunch of other robustness checks. And so this is my last slide. What do we find? We find that UPI increases retail investor participation. So one standard deviation higher UPI exposure increases active investors by 8.6%. And there's also increase in monthly transactions. This also democratizes investment access. So effects are stronger for small investors. They're stronger for women, young investors, and investors with fintech brokerages. And finally, we look at, and this is very preliminary results, we look at investor outcomes, and we find that small investors have negative excess returns, greater risk taking, and lower portfolio diversification. And finally, we look at the aggregate stock market impact and find that high exposure stocks exhibit greater volatility and greater trading volume. And that's about it. Thank you. Yes.
So this is extensive margin. Are there effects at the incentive margin as well? Am I transferring more into these accounts? Are you able to see anything people that had accounts before, whether the
Yes, so basically this is both. It's the active investors is both people who were dormant before, who increase their activity, as well as new investors that come on.
but this is number of transactions, right? So, or number of investors. Rupees going, is it, so rupee per investor is also going up?
Related question, can you see where the money is coming from? How are people reallocating?
We don't have full portfolio of the investor, unlike Nicola's, so we can't tell where it is coming from.
Through Pulak can figure out the way.
We'll think through that.
You mentioned this in terms of democratizing access, which has a positive spin on it. Is there any, can you study whether there's also any negative effect? So I'm thinking of going back to Terry O'Dean's paper in Vietnam, where traders were losing money. I think that was mostly coming from the transaction fees that they were losing. Otherwise, they're kind of break even. So maybe in this case, if transaction fees are low, that's not happening. But then we can also think about Raghu's comment last night about zero-day options trading. There's been work in developed country markets by Anna Pavlova showing that people are losing a lot of money, getting taken advantage of by not knowing how to price these, not knowing the value of these zero-day options. Can you tell us anything about that?
Yeah, that's what we're going with both of these outcomes, which is that yes, there is an increase in retail participation, but it might also be that both either the small investors, they seem to be making negative excess returns, but they might also have these behavioral biases, which is what we are trying to look at. And a little bit a precursor to that is the third result, which is that you already see it in the stock markets. The stocks which have a higher fraction of investors in these high exposure areas, they exhibit greater volatility. And that, that is again Terry O'Dean's work, which shows that on one side, there might be improved liquidity, but if there are these behavioral biases, it might actually increase even lower liquidity and increase volatility. But that's where we're going. Yeah.
I wonder if there is a way to back out what's the implied cost, the reduction in the cost of using stocks, of accessing stocks. It would just be interesting because it would allow us to have some elasticity that could be used in models. And the second thing, it would be interesting to see what happens to gambling. If there is any data on gambling at the local level in India, you can have a measure of exposure, because it looks like that these new entrants are probably just trying to go for some high ticket returns and on average losing.
Right. So we do, within this context, we look at risky assets. We find there is an increase in risk taking. But are you thinking about like crypto or something outside of the stock market? Yeah. Maybe that, but also maybe even the FNO market. But I think that's a little bit outside of the scope of what we're going for here. But yes, yes.
My question is is there any way to also understand what is the effects of simplification of the trading infrastructure along with the payment infrastructure? So how is there more integration of, let's say, broking platforms and their apps and their creations and their integrations to these UPIs? And they're made so it's not just the payments that are made easier, but also like trading on your mobile phones and things like that.
So we have this one result on fintech brokerages. So we know the brokerage, and so these effects are stronger with fintech brokerages. So probably that also has a role to play. Yes.
Maybe a little bit skeptical. If I'm like a new investor in India, if I'm opening an account, do I have to do any KYC process or something? Because usually the transfer of the money seems like a very minor thing compared to number one, the prove my identity, prove my wealth, and then this two-step authenticating your payment, your transfers into the account. That's also very minor compared to T+3 settlement but I don't know if India has strict KYC or T+3 settlement. So
It has KYC. I think we should look at how cumbersome it is. It is not supposed to be that cumbersome. Even the settlement, I think it's reduced over time. So maybe that is something that I can actually look at.
A way to exploit the geographic variation in like employment or other opportunities to see what is probably driving or which states are driving this growth.
Yeah, that's a good idea. Looking at, we just looked at young, but I think unemployment also would be a nice finish. Okay, thank you.
Less slides means we're on time. Correlation works the right way.
Try not to disappoint.
Depends on the number of slides.
Awesome. So yeah, so great to be here. I work on finance and development broadly defined, and a lot of my recent work is trying to think hard about financial contracting when there are information asymmetry in markets. And I mean, I don't need to discuss more about the role of like how prevalent are information asymmetry to this crowd. They characterize financial markets, more so in developing countries, and have large welfare consequences. So most of my work is, or most of my recent projects, which are mostly RCTs, are in this space and span multiple markets, product space, and geographies. And the three main areas I'm working on right now are borrower screening, that how can we use new data, for example, through cash flows or transactions or networks, to basically feed out these hidden types and how that interacts with either traditional loan making through loan officers or better algorithms. The second one is like product development of new innovative financial products, mostly focusing on debt markets, not on equity markets or like equity products like Mohammed has done. It's mostly to develop products which better align borrower and lender incentives. The third one is loan modification strategy, and that's what I'm going to talk about today, which is shocks occur post-origination after loans, right? It could be liquidity or moral hazard, and through RCTs can we better understand what are the drivers of default in different markets and different product space. So the project one is basically trying to understand how effective loan modifications or to understand effective loan modification, we need to understand what drives default, whether it's liquidity constraints or moral hazard. And so what we're trying to do in this paper is like just a very simple but powerful theory of introducing liquidity constraints, which are prevalent in like SME operations in developing country into an otherwise standard, simple corporate debt overhang model. But it generates a very strong prediction, which is that when SMEs face liquidity constraints and there is a threat of like collateral liquidation of the thing that they're operating, then that basically reduces effort and investment because of this like inefficient liquidation. And it basically interacts with classic debt overhang. And we take this simple model and like use it strictly to discipline on RCT, where we restructure about $75 million worth of poorly performing debt with a large or like a top 5 publicly traded lender of minibus taxis in South Africa, where these borrowers are borrowing these taxis against and these taxis serve as collateral against those loans. So what we do is that we randomize basically to half of the people, actually 1/3, but like for simplicity, to half of the people, we give like a large debt reduction without changing their short-term liquidity constraint, and to the other half, we basically give short-term liquidity we relax short-term liquidity constraint through payment reduction without changing long-term debt. And we actually measure outcomes of these changes in financial contract over and beyond entrepreneurs' repayment decision. We actually are able to track their business decision through effort and capture through GPS devices in these minibuses. And we also link their outcomes to like credit bureau to capture externalities of this loan modifications. So what are the main findings? Is like, so this crowd will find it unsurprising, liquidity constraints match. Okay, debt reduction does not affect anything for liquidity constrained borrowers, but payment reduction is not necessary.
To have payment reduction any effect on borrower outcomes, you also need to have sufficient vehicle liquidity or low levels of debt to begin with. So there is this like interaction going on between liquidity constraint and debt overhang that has implications for like modeling and policy. So collateral need not really align borrower incentives with lenders' objective function here. And there's a pecking order for how modification should occur, given there are these like different costs of like reducing debt versus reducing payments, right? So there are two more projects that are motivated from this that are currently in the field. One is this ex ante commitment to loan modifications by writing state contingent debt contracts. And second is on risk-based pricing, because this lender also has in-house auto insurance. And there are negative externalities in this market. People die because of accidents. So we are basically creating a risk-based dynamic insurance pricing model to incentivize safer driving, but there is this risk-return trade-off. Okay? One thing I forgot to mention, and we don't do it enough, at least I don't do it enough. Let me thank my co-author, like for all their patience in like working with me over like all this research. Okay. So the second project is like carrying this forward, which is trying to understand why do borrowers repay their unsecured debt. So here we change gear. We move from collateral to uncollateralized loans, from SMEs to consumer, from South Africa to India. And we ask basically some things about like, okay, why are consumers defaulting in this market? And we work with a large digital, like a really large digital lender in India, where this lender praises itself on like fast approval, like we heard yesterday, similar to many other fintech lenders. Okay, like within a day you get the loan after applying. And while it relies on a lot of this alternative data, it also relies like heavily on credit bureau data. Okay, but credit bureau data has lags in reporting. Like when people report, like there's 1 month, 2 month lag when it appears on the report. Okay, this is going to be super important actually. I cannot disclose the default rate just because like I'm not confident enough. It's like a fresh off the oven paper, actually not a paper, like it's like fresh off the oven RCT. So the default rate is greater than 20%. But one fact we document in this setting is that there is a large prevalence of never payers, borrowers who never pay a single penny after borrowing. Okay, so what we are doing is that, and hence the title is that we're taking the sovereign debt model and applying it to like consumer debt theory. In sovereign debt, it is a question like why are sovereigns not defaulting on their debt? And there are three prime theories there. One is like penalties, default costs. A lender can impose a default cost on the sovereign or cut off future access to credit, right? But these theories fail if there are multiple lenders because the borrower can borrow from one, default from a lender, and then go back to another lender. Okay. So in this setting with multiple lenders, what happens is that you need a reinforcement through reputation, through information sharing and creditor coordination. And in consumer debt, that occurs through credit bureau. Okay. So what we do is that we basically, to tackle these questions, we do 3 RCTs with this lender on different dimensions of portfolio. And then like, so surprisingly, a very large lift was this obtaining credit bureau data in India on borrowers' credit inquiries and the associated decision on their application, plus conditional on receiving loan, what was the performance. So what I find, or what we find right now is that, so the 3 RCTs are one on their like defaulter portfolio. We give people option to settle their debt through taking a haircut between 0% to 50%. What we find is that settlement take-up is low, but it's actually increasing in haircut size, but never payers are not taking up these offers. On the second experiment, we give people information about cost of defaulting, benefit of repayment, and we find that it has none precisely estimated 0 effect. Finally, we give people a chance to like obtain 3x the larger loan size, so dynamic incentives similar to Carl Arms Inman, but on like loan size rather than interest rate. And we try to see what are the effects of this. We do find some positive effect of this. And so next step is just linking this credit bureau data to study whether there's prevalence of loan stacking, because under these fixed default costs, borrowers should amp up their like default to max and basically just default on everything if that's strategic. Okay. So we are using credit bureau data to answer that and track repayment behavior. And of course, this is like super new, like we don't have even a paper yet. So I'm super open to like suggestions here on what you think about that. Thank you. Thanks to the press for organizing this amazing conference.
On the last project, do you have information on do individuals borrow from multiple platforms?
Yeah.
And is there evidence?
Only the ones that report to credit bureau.
I see. And do you see evidence of cross-platform adjustments?
So that's the aim. That's what we are trying to do. What do you mean by adjustments? Like taking money from one campaign to, I mean, that would be net effect. That's what we try to answer. We won't be able to follow the money, but yes, on net, that's the thing we are trying to answer.
Because it's, go back to the, the Banerjee Duflo paper and all the stuff where that becomes also a test for credit constraints.
So this is the thing which is the biggest challenge in this paper. Like, is it liquidity? Is it something else, right? And hence the reliance on never pairs. In a model, like, of course, like these could be like people who are like, so our theory is the following. There are the super hyper strategic borrowers that exist in the market, in unsecured debt market, and those are the never pairs. It could still be that you take out a loan and you receive like some exposed shocks, right? But I mean, these are 3 month, 6 month loans, right? What is more intuitive? Like that they're strategic or they're receiving these shocks? I'm not denying it doesn't. We are not there yet in terms of identifying whether it's like liquidity in this market.
The first project, just a question about the context. Like, do you know how these loans are? So are they structured like? Do the bank ask for a collateral? Or do they ask for like conditions on earnings? Because my understanding it is that essentially a lot of banks ask for like earnings rather than collateral.
So you mean this?
Yeah.
So yeah, I mean, so this I can speak at length. Like, so this is not a bank. This is a actually asset-backed lender.
Okay.
The collateral is only the most. There is limited liability.
And this is about collateral. Okay, because I guess like what I'm trying to understand that like the bigger picture here it is that how should we design this type of loans, right? Then like my understanding is from the macro literature it is that we used to always model only with the with collateral, but actually that's not how lots banks behave.
I mean, there's this amazing set of information on cash flows. Then you use it correctly. And we're not there, but we're moving on.
It is happening already, no? Like apart from the literature, I mean, like in the real world.
Okay. I mean, we need just more evidence. And to be more like I made a point out yesterday, like what are the distribution codes? Just an average. Completely.
This might be a bit of a naive question, but in the last project, is it possible that the never payers are like victims of identity fraud?
Oh, hey, good point. I don't have an answer to that. We never even thought that. Yes. Good. Yeah. Identity fraud. I mean, I've never even thought of that in context in India. Yeah.
I mean, it is that fraction actually of these never payers.
Sorry? Oh yeah. So conditional default, more than half are like never payers. That's why this is a fact, not like this is like
3 month contract. If it's a 3 month contract, it kind of probably is not surprising. There's never.
Yeah, but like I mean, still you have costs to default in this market. Like you get reported credit, or people just default, or they don't care. All the defaults are low. That's exactly what we're trying to do. I mean, this is just puzzling. Like you pay zero. I mean, one of my co-authors on this is like Zilman. He has never observed this in like the prevalence, large prevalence of these people in any of his projects. So maybe I misspoke, but
what's the default rate? Did you tell me? I'm maybe missing.
Yeah. So overall default rate again, like this is where because it's like really like a work in progress. Like it's greater than 20%.
20.
It's greater than 20%. Yeah. And actually
percent of all borrowers are never pairs.
Yes. And in fact, like the APR in this market is right now at 50%. Like 3 month loan, 50%.
But why is that surprising in some sense that if you are looking at people who need those loans to operate a business, then I understand that it's surprising. Otherwise, if anyone can have one where you take one of those loans, pocket the money.
If you are just a one-time borrower, yeah, you would do that, right?
Yeah, exactly. Yeah. It would make sense for
unless there are like moral constraints or like other things. But yeah, one-time borrower, yes, that's exactly what we're trying to do. Yeah, totally agree. Yeah.
Thank you so much for having me here. So this is joint work with Emily. So all the errors that I present here is my own. I'm not Emily. That's the disclaimer for this. I mean, you could hear yesterday from the various talks, right, in panel that there's a lot of hope in how data on instant payment systems and open banking could transform trade markets, not only in developed countries, but obviously also in developing economies. So this is going to be setting in Brazil, where Brazil is, I think, one of the front runners actually on implementing these policies, both in terms of PIX and open banking, and in some sense in a very advanced stage. So what we present here is actually extremely very early version. So most of the interesting thing that we want to do is still in the works. So what we'll kind of show here is more an obvious outcome. So how does open banking affect credit outcome? If you think from kind of theoretical point of view, there are two ways of thinking. One is a positive side, and the classic way is there's more information, and more importantly, more verifiable information by lenders, right? You generate transactions, fixed transactions that everyone can check. This should lead to more financial inclusion and also to lower interest rates because of competitive effects. So more people, more banks can bid on the same information. Now, if you look a little bit on the negative side, which I think kind of makes it more nuanced, right? When you think about the implications of open banking on the credit outcomes, there are kind of some parts of the population can easily be excluded. So even if you think about the classic monopoly ranks of banks, once banks lose this, they don't have incentive to invest in acquiring information about people who don't have really this hard information. Or even if you think about the asymmetric cost of open banking, kind of cost reduction, so people who are existing borrowers, so banks will have disproportionately lower cost of getting more information than new borrowers. So banks are going to have more incentive to rely on this stuff. Good borrowers can be easily poached. So again, you don't want to kind of screen because the next guy can come and again take away your investment. And also there's this thing that most of the times it requires an opting in into sharing information, which again, because very important when you think about financial education and things like that, because not many people will even understand what does it mean for their own point of view. So this is where we want to go, and I'll try to understand these trade-offs in the data. We are not there yet. We're actually far from there yet. So I'll just give you kind of what we have so far. So what is our design that we want to do in this paper? It consists of 3 pillars that are very important and really cool for Brazil, besides having amazing data out there. So one, open banking Brazil is really really advanced. So in 2025, there are 40 million unique customers that use open banking. So it's very advanced, very widely used. Joining of open banking by banks is a choice. So what we'll use for that kind of challenge as well is there's a lot of within bank variations we can exploit. For instance, secured versus unsecured, right? If you think about where information is more valuable, it's going to be for unsecured loans rather than for secured, because you can pledge your collateral that way. There's a big difference for legal reasons for firm versus retail adoption. And the simple rule is that it's very tricky for a bank to verify who has the legal right to approve sharing of information for firms. So it's not really kind of a streamlined process yet. So the adaptation rate for firms is extremely low for those reasons. And so what are the event dates that we'll use? We'll use the certification dates. So we have the dates when each bank had their API certified by a third party that allows them actually to start communicating with the system. Just to give a kind of idea what it means when you get certified, so you can't really use this information before. Once you get a certified approval by a third party, the banks really start kind of sharing the information among each other for the clients. So, depends on the bank. Some of them are very aggressively acquiring or sharing information. But the important part is that it is a required and necessary condition to be satisfied that we'll exploit in our work.
What's where the yellow and blue line?
Or transmit. Whether you see or transmit. So, for instance, fintech, Nubank, those of who you know, Nubank is the largest digital lenders in the world. They're like extremely on the receiving side. Then if you look at some old legacy banks, they'll be on transmitting side more. So this is just to say it's really important. You can't really share information before that. Okay, so the boring results or the important boring results of open banking is that once they join the bank level, once they join the infrastructure, the lending goes up. So overall, banks lend more, and they more and more in unsecured segment, which is kind of what you would expect. They want to lend and want to lend in this kind of area where collateral might be limited, but really the information helps me to know who is good and who is bad. So unsecured is the one that benefits most. What we also find is that the retail borrowers, which again is kind of a technical issue about the open banking, that retail banking, as expected, is benefiting more. Again, this is like a within bank variation where we can control why the bank decided to choose and this and that, and really exploit the fact that firms really cannot share their information. But retail customers can share, so the data is still a little bit, messy. It's an early world, but the one thing that's really clearly emerging that the retail borrowers report in terms of total credit and also the number of borrowers, that's really kind of going up. And importantly, also their prices are going down. So more credit, more for the unsecured, more for the retail at lower prices. And this is again, right, this is a quirk that's great for identification just because it's difficult for firms to share the information. Now, most of the things that I want to talk about are still to be done. So I think what are kind of really interesting things that we're working on now, which I think is can really enrich the analysis, is think about these borrower bank month interactions, where you think about some, what does it mean for a borrower when a new bank joins the network? Or what does it mean when a bank that has some information about me joins the network, right? So there's a lot of this strategic information spreading, and so who gains, who loses at that point in time is very important. Second one that really comes up a lot when we talk to the industry people is about strategic communication. There is a lot of, so let's say one of the largest lenders in Brazil would just tell, well, what I see from the data is whenever somebody comes and shares to me, they share only great stuff, but it turns out it's all bad because I didn't share the other stuff. And that kind of becomes really strategic, that I think is very interesting kind of look in the data, because as an econometrician, we actually will know everything, but banks might not know everything. And then obviously thinking hard about who are the winners, new versus old customers, new financial inclusion, and who has less and more information, things like that. So I think that's where we really want to go with this paper, where I think is going to be the most interesting results. Thank you.
I guess now I see where the question yesterday to Manju was coming on the firm side. What are the main reasons why it's hard to share? What do they say? Is there anything you can do there?
I think it's more the technical, like legal reasons where they have to streamline the process to ensure that they have verified you have legal authority to approve sharing of such information. Exactly, that signature confirming with the registry of the firms. So it's more like just streamlining that process from the ultimate authority to the one who actually is sharing the information.
I guess it might be interesting to see like what there might be some variations you can use. As firms will have it easier, and because
this is actually yes. So small businesses, this is actually what it will do. So small businesses, where is the 2% thing? They have one firm, one owner. Those can share. Once it becomes larger, it becomes different. Yep, it's a good point. Yep.
You look at kind of like with your data, unbanked borrowers. Like I think one interesting thing about open banking is that it can change the incentives to, lend to unbanked people and learn about their type over time, because essentially all the potential benefits of that learning go away. But I'm not sure if you can see unbanked individuals.
We do know, because I know the population of Brazil, and I know who has a relationship with bank, and I know what are the transactions. So I can do. I think the preliminary result that we know is that the biggest gainers are the ones who already borrow. Right. The inclusion effects are going to be very minimal, actually, and I think the very excluded population might actually really be excluded at this point in time, just because they don't have any.
Why?
Sorry?
You know that? How do you know that essentially the effect of excessive margin is small?
I just observed that.
I see. So then you're talking about in terms of, okay, you're not making a welfare statement, you're just talking in terms of quantities.
Yeah,
most of the increase in volumes comes from the intensive, not from the extensive margin.
Yeah. So I know who is unbanked, I know who is banked but doesn't borrow, I know who is banked and borrows, and user speaks or not. I know all those kind of distributions. I think this extensive margin will be kind of limited.
Impact, but I guess then there is a extensive margin, like it could be that then maybe like you're reaching some fraction of the population at first may have like an extremely high welfare effect
Oh, yeah, yeah.
for them, and then second, maybe you're gonna actually find, you know, individuals that then can, like, you know, become a gazelle or, you know.
Yep.
So it's clear, I guess, in the medium term.
I think welfare is very, I mean, that you have to know what their, you know, benefit is. Just, I can say what I see, but not what the welfare is.
I was thinking if you could look at spillovers to other banks, so banks that don't join, but maybe are competing kind of in the same area for similar customers, and whether they are, again, changing a bit either the composition of the loans they have, but also kind of,
I think
the
that's,
question of investing in extracting information through other means or screening.
that's kind of what I'm working on. I just realized that the data set bank month borrower panel is like, it's kind of where I'm going, but it's hard for now. It's a very good idea. Nicola.
I have two questions, Janis. One is, you showed the event study increase in credit. That's interesting. I'm wondering if at the aggregate level, we also see an increase in credit, or, you know, if it dissipates through the fixed effects. Second is, does it change the way in which banks compete? So what you're telling me is that now basically some of the informational advantage of banks is taken away by this sharing, but can they use other tools to create trends like economies of scope? Basically, I try to retain you by offering you different products. I don't know, I would think maybe something like what Mohammed does, you know, I don't know if they can do asset-based lending, but basically trying to escape kind of, you know, this low margin, commoditized credit market.
It's a very good point. Long story short, from our discussions with the industry, is that they want to do that. I don't think they're there yet, but I think that's going to happen, you know, sooner or later. They will have to compete in some margin, right, where they can keep monopoly rents. I don't know whether we will be able to say it to what extent. We can explore in some product segments what they offer or don't offer, but I'd imagine it too, but I don't know what I would say.
Just following up on Emanuele's question, it would be interesting to look into the individuals to try to observe those that are wage workers, for example, in highs, for example, if they have access, because then we could identify the potential entrepreneurs, for example, self-employed people.
I think basically that's kind of the whole point for individuals should be informal workers. That's where really the benefit should be there, because collateralizing wage contract is pretty easy in some ways, right?
Honestly, just like one thing I'm seeing over and over again in like multiple countries is the adoption at firm side is extremely low all the time. Is the individual who are like the forerunners of like adopting this technology. Is there a possibility to do like a survey?
Our hope is to do an RCT with that, to be honest. Because I think if we really want to change the world, we have to get the firms to, you know, really invest and borrow. Like, it's not happening. And, you know, we actually ran surveys, right, Emily? And firms don't really know what it is. It's like, it's just awareness, it's so small. And I think it's really, it's really important. It's really, really important to make it work. It's not working. It's really not working.
So
I think we're out.
We should go to the break.